it's obviously from a European point of view, European stocks point of view, really important to watch this Fed narrative because it seems to tie so much into reflation expectations or the reverse of reflation expectations, depending on which day we're talking about here. Today, we seem convinced that the Fed, yes, it's a little bit more hawkish at the margin, but it's only going to withdraw support very gradually. Is that where your focus is?
Yes, I think that's right. I mean, first of all, you're completely right. It feels like everything, all the decisions you want to make in asset allocation at the moment stem from where you think that 10 years going. So the growth versus value, the US versus Europe, tech versus financials, all of this really does hang on that 10-year yield. I think the message from the Fed is, as you say, it is time to take the foot off the accelerator. We have come a long way in the last 6 months in terms of the reopening, learning about the strength of demand coming out of the pandemic, but also learning about the success of some of the support schemes. In the US, the fiscal stimulus, in Europe, the labour market support. So basically, we're coming out of this pandemic in remarkably good shape. And I think, therefore, the central banks are right to acknowledge that. They're right to mention that the balance of risks has shifted and to ease their foot off the accelerator. But they're not going to be in any hurry. I mean, I think my interpretation is they will probably end up being too late and therefore actually be slower, but have to do more in the longer run.
And which are the assets then that are at risk? Because even if it's not going to be a hurry, even if the Fed is not going to about turn very quickly, Karen, we are still then we are now watching for where the talk of taper turns into the actual action of taper. Clearly, you know, the Fed has been buying treasuries, they've been active in the mortgage markets. Which are the assets that you're focused on then that have really gone too far with all of this generosity from the Fed and also, I suppose, from fiscal authorities?
Yes, well, I think it's going to create us some volatility and days where nothing does particularly well. I think we've seen already over the course of this year that, you know, when we have a miscommunication or a misstep from the Fed and we have a particularly large move in the 10-year, then nothing does particularly well in that period. And there are going to be days like that. I think we should just brace ourselves for that volatility and not lose our head. I think if we see this sort of sustained upward march, then it might act as a little bit of a headwind for some of the areas of the market that have really benefited from zero rates and flat curves. So I'm thinking here, some of the tech stocks, some of the growth areas of the market. They've still got very strong earnings, so I'm not desperately worried about what they do, but I think it will act as more of a headwind. And then on the other side, however, I think you're going to get those areas of the market that were the real losers of zero rates and flat curves, such as financials, really catching up, which supports the overall market narrative. So I think that broad markets will still be okay in a rising yield environment, but because the earnings expectations will be rising. But we're definitely going to have days where screens of red, and I think we should just not get too alarmed about that.
OK, so we brace ourselves for that. And you still believe then in this rotation into some areas of value. Karen, where is it that you see markets well supported by that theme? Is that a very much European trade?
Not just Europe. I think actually areas of US value still look attractive. I think the financials, I do think we're going to come out of this with central banks being able to get off the zero bound, even in Europe. It might take a little bit of time, but ultimately I think that those risks of negative rates, which have really plagued the financials, will recede. And I think we're going to have a credit cycle again. We're all focused on government debt, but we haven't realized that households have done a pretty good job of paying down debt in the last 10 years. So that's all going to support the financials. But I do think it will play to Europe's favor. Not only have you got some of the financials heavy value heavy areas of the market in Europe, but I think Europe's really going to be one of the beneficiaries of the focus on sustainable investing.